Okay, so the market went down substantially last week. The S&P was down like 1.7 or so on Friday, and it was down like 4%. And I don't expect it to stay on this particular, pitch. I think it's going to have some kind of rally in the coming weeks. Now, I'm not focused on next week. I'm more interested in, what's this market going to do over the next quarter and into 2025? And I think the whole story around recession is real. I think there is enough there to expect a recession, but I don't think it's going to be all that bad. It's not led by some big giant problem like the subprime mortgage meltdown or anything like that. But I think there is going to be a slowdown, and I would point in large part to the issues of, and it's not an issue, it's just reality that in 2021 and 2022, the government in the US really stimulated the economy. And you see the market just really go up because companies were literally not having to pay their employees because there was certain stimulus that companies were receiving as long as they keep their employees employed full time. They had no payback grants, given to them. You have individuals that received checks, stimulus checks, and they went out and spent, on new things, new discretionary things. So now that all that money's gone, because it was kind of stimulation time was 21, 22, the economy had to kind of fend for itself, and it hasn't been as good since then. Now, as we go into the now, which is 2024, you do have a little bit of, okay, we're having a hard time growing, especially as we compare over the last 2-3 years, and the consumer is beginning to be tapped out, and that's 70% of our economy. So I think that has something to do with it. And we'll see how things sort out, but I'm glad that I did put more cash, in my portfolio, and I'm actively buying into companies that I want to own. The good news about having bonds is that as they mature, I'm probably going to take those proceeds if the market keeps going down and putting it into equities. And then when equities rally a lot, I'll put more money back into bonds. So that's my general plan of what I'm going to be doing. How about you?
Oh, I guess I'm the only one here, right? So
Yeah.
yeah, so I definitely, even though I do have some experience in the markets, as an intelligent investor, like let's say someone who kind of has a grasp on what they're doing, I'm fairly new. So I am learning about bonds now, right? And I personally am trying to buy into treasuries and bonds now, but that's because for treasuries are always safe, right? So my philosophy with that is that's always safe, but now is the kind of the last minute to get the good rates on the T-bills, right? T-bills and T-notes, because rate cuts are coming. Look, the yield curve says it all. It's not super steep, but it is uninverted. As I'll send it to you now. It
went from being positive. Inverted. Let's kind of see this together here. So
sure. Yeah, it's the one. Well, the one I look at is the 10-2 spread.
Yeah, that is what they compare. So this one, we'll compare it to the 10-year.
Also, with investing, it's always good to know your time horizon, right?
Yeah.
How far out you're looking.
So as we look at, is this going to show it to us? Yeah. So the 2 years represented in the dark green, and then the 10 years represented in the green, and it's been inverted, meaning it naturally should be above the 2 year because an investor is taking a higher risk. I'm going to commit to a loan to the government for 10 years versus just 2 years. So how is a 2-year promissory note, a bond, priced to pay me more money? So it was inverted. It started to get inverted back here, and now it's not inverted. So changing it to the 5-day is, let me try this graphing tool here. So you can see on the tail end of this is when it became not inverted. You see that? So the long and the short of it is that I'm glad I've got the next really 4 years completely bought in bonds in my bond ladder. I was buying into my 5th year. I think I'm up to 66,000 or so, and I want to have at least 80,000 out there. But now it's going to be about looking at that 10-year treasury or quality bonds from corporations, because that's going to have a higher yield. And, it's going to be money that I don't need. It's just out there collecting income. And I don't want all my money, all my liquid assets to be in stocks, because this past week is an example of why you don't want to go all in on one asset class. Not at my age. It becomes a very uncomfortable scenario if we get into like 2022, where we had a very good correction in the S&P and the NASDAQ. I think the NASDAQ has a more dramatic drop. So in 22, it dropped about 29%. That's a significant drop. So tech stocks and the like just really went down. So
could I ask, what was the story in 2022? Was it, inflation became an issue in 2022, but that's not it, right? There are others.
I think part of it is you had this go-go period, right? You had the market over 2 years went up 133%. Yeah. That's phenomenal, right? That was great. But it's like, okay, that isn't sustainable. So the market, stocks gave back a lot of those gains, and I thought it was necessary, because if you really look at the last, call it, after the subprime meltdown, the market's been doing great. Nobody should be complaining. We should all be like, great, I'm glad I own stocks. look at this rate of return. You see the steepness of this? It just was getting too steep and needed to be corrected, and it corrected. And now it's back. It's doing it again. But what really has carried the market to very high highs is, in a way, the AI hype has made semiconductors very vulnerable to being corrected. If not, I guess, I don't know if the Broadcom investors could call last week a crash, but it certainly was really bad for Broadcom. If you look at their 5-day, it went down 15%. And let's look at year to date. From the top to where they're at now, it's down 25% over the course of 3 months. So things are really correcting in the semiconductor industry. And for good reason, I think it should, because you have stocks that have been run up too high. These stock prices are not sustainable. So that's happening. At the same time, like when Broadcom goes down, like Qualcomm didn't participate in the big run up. They began to a little bit, but when you look at here's Broadcom, here's Qualcomm, and look, Qualcomm's actually a better investment over the maximum. But let's look at the year. Actually, they kind of matched each other. Having to take back what I was just saying. I guess recently it didn't keep up with Broadcom. But I'm beginning to buy into Qualcomm because I like Qualcomm. I like their fundamentals. And whenever the market corrects like this, it kind of gives everybody a haircut, whether you need it or not. And I think Qualcomm's a pretty good buy. So that's where the opportunity starts, is if you know of good companies that you want and it's being discounted, hey, great, thank you. I'll buy, load up during a time where a stock like, in my case here, Amazon and Qualcomm are being discounted. Because if we look at the 6 month, you see that Qualcomm is down from 30% from its high. And I think it's discounted. So I'm going to start buying and dollar cost average in my investment. That's the kind of stuff that I want to do, because I know it's going to make me a lot of money over the next 3 years. It may feel awkward for the next 6 months. It may feel, as long as we're in this bear market or this correction, it won't feel warm and fuzzy, but it's the right thing to do. And it's proven itself over and over again at every correction that I've been a part of.
I have one question, if you don't mind. And it's just going back to the bond question for a second. Mm-hmm. Something I don't think I've ever heard you mention are junk bonds. Yeah. You mentioned quality corporate bonds.
Yep.
But, what is your opinion on junk bonds? I mean, first of all, we should cover what they are, right? Because not every corporate bond is automatically a junk bond, right? It depends on the rating. Is that right?
Yeah, and I don't know how quite to define. So let's.
It's like high yield, basically.
Yeah, I know what it does, but what is kind of like that threshold? At what point? So a junk bond is a corporate bond that has a low credit rating, considered high risk investment. Okay, so let's talk about what I would think is a junk bond, right? So I'm an investor in, I'm going to first define what I think a good corporate bond is. And this isn't opening. So I'm going to say Qualcomm, right? Qualcomm is a good company. I've analyzed it. I think they're a company that's going to do well. So if they issued out bonds and let's say they had a triple B rating, I'd be very comfortable. That's not a junk bond. Okay. If they had a term of 5 years, I'd be okay with that. Now, let's say you have a triple C rated company, which is a big rung lower. And this company has a significant amount of debt. Debt's like 5 times EBITDA. They've struggled over the last 5 years. That's a junk bond. Now, the yield on that, nobody wants to buy that debt. So the yield on it's 12, 14, 16%. But you're taking a really high risk. If I'm going to take that kind of risk, I'd rather buy a good stock in a quality company versus trying to get there through junk bonds. If you know of a company that is like just misunderstood and they're on the road to recovery and you really feel conviction around that, maybe you do buy those junk bonds if they are classified as junk. But that's how I don't have any junk bonds right now. I have one bond that you could say is riskier. It's with the oil company down in Mexico, Pemex. And my yield on it's 12% and it's locked in for the next 7 years. So that's awesome. To me, the oil complex in Mexico is, I think, a reasonable risk. The Mexican economy is doing well. There's a lot of things there that I'm comfortable with, but it is outside the US. So there is more risk, but I am making 12%, which is a very good return. So that's as close as I get to the classification of junk is an international bond with a Mexican entity. Pemex is a nationalized oil company. It's not like Chevron or Exxon. It's nationalized. So that's as far as I'm willing to go. I'm familiar with Mexico.
That bond is paid in US dollar, correct?
Yes.
Which is good.
It's issued on Wall Street. It's US dollars. It's, all those things make me feel warm and fuzzy. Now, if you said, hey, I've got one in Thailand, I'd be like, yeah, I can't. Step one, the answer is no. Like, that's outside my wheelhouse. I don't have enough familiarity, knowledge, comfort level to make that investment. So
how about Switzerland? The interest rates here are quite low.
I'd be comfortable with like Switzerland, Germany, United Kingdom, probably France. To some extent, Japan. Yeah, I'd be comfortable with Japan. Talked about Mexico. I have invested in Brazil in stocks, but not bonds. I don't know about bonds in Brazil. I think I'd be careful with that because I think bonds serve, and hi, Sia, thanks for joining. I think bonds serve my portfolio to be a low risk asset. Turning them into a higher risk asset, it kind of, that defeats the purpose. You want them there. So like weeks like last week, the value of all my bonds went up. Now it didn't go up substantially like my stocks dropped to the equivalent of the drop in stocks, but you see it work. You're like, okay, great. My bonds are worth almost across the board 1% more at the end of the week than when we started at the beginning of the week. And my yields hold steady. So that's why I have bonds. Bonds are meant to cover my living expenses for the next 5 years. I want to always have my next 5 years taken care of. That way, no matter what comes our way, I'll figure it out in 5 years. And
if I can just mention something that I think you brought up, I think when you were talking with the Yield Nerd, we were talking about credit ratings, which is a kind of a canonical, if you want to say, way of differentiating a junk bond versus a quote unquote investment grade bond. And you mentioned that, yeah, you do look at the rating, but you don't just go on that. You make your own analysis.
Right. So ratings could be, so for example, like, I don't know what, let's look at Qualcomm again. And I think it'll help me prove my point. So triple B, okay?
Yeah.
I'm very comfortable with Qualcomm. Now, triple A rating would be like Apple or Johnson & Johnson. And let's kind of look at that for a second. Johnson & Johnson had legal issues that were huge. The whole baby powder class action lawsuits, that is huge. So I'm actually more comfortable in Qualcomm versus Johnson & Johnson. So those ratings are a little cloudy to me, a little gray. Like, well, what does triple B mean? What does triple A mean? So I'd rather look at the company, get familiar with it. And some of them I already have familiarity with, and make my own decision based on what's their balance sheet look like from a debt perspective. And then I'll make my decision. So I know that like the yield nerd, he was purely, it's almost like he was a technical trader on the bond side. He only looks at technicals. He was like trying to make short-term gains, and the gains were really small. I was thinking to myself, if you're going to put that much effort, why wouldn't you want like a 30% return versus he's just trying to get a 0.25% better return on bond yields? And it's like, you're like fighting to get a 0.25% better yield. That's not enough for me to fight. I want like, I'm going to fight to get a 20% greater return on a stock. That's what I'm fighting for.
Yeah, it's a question of risk, I guess. But,
yeah, it's comfort level. You know, one of the, I'll try to bring it up, but one of the realities is that when you're in equities over a 10-year horizon, you're going to make more money. You're going to have a greater yield than bonds. That's a reality. It's just the path is going to be smoother with bonds. You're going to get from now to 10 years and just have subtle moves up and down, and you're going to have a consistent yield. Okay. Bingo. That's what you get with bonds. Now with stocks, you may have weeks like last week or years like 2022, but at the end of 10 years, you're going to outperform bonds. That's proven. That's data driven. There was one exception in the 80s, but that was just completely different. And is it going to repeat itself? I don't think so. Not at least in the next 10 years.
Okay. One quick note, and I don't know if you've seen this, but just from personal experience, I have seen companies that have multiple credit ratings. You know what I mean? So
no, I've never seen that. Tell me more.
It's more common with banks, like UBS. So I live in Switzerland, right? So I was looking at UBS, and so they're a global bank, so they have different branches, right? They have a branch in the US, they have a branch here, and I think that the different, like the bonds from the different branches could have different ratings. So like, for example, the London branch might have a different one than the one in Switzerland. But then also there's different categories. They have their own kind of junk bonds.
Interesting.
They have their own almost like portfolio that you can choose from. So I don't know if you've come across this, but I think certainly in the financial sector, you come across it more. So it can be more complicated, just so people know.
Yeah, that's very interesting.
So like,
I didn't know that.
Rating, don't assume that that's the rating for the whole company. They may have other bonds with different rating.
Super interesting. All right. Very good. So let me get back to the. So let's see. Let me look at the chat. Hi, Sia. Very nice for you to join. Thanks for joining. If you have any questions, feel free to put them in the chat or ask away. So going into next week, I've got. My process remains intact. I continue to, if the market discounts, you know, the companies I want to own, I'm going to buy. I think I have enough cash to, you know, keep buying until the end of the year. If it really melts down, then I'll have to figure out where to get the next, you know, load of cash to continue to buy equities if it gets to the end of the year and we're still in this downturn. But I don't know what's going to happen, but I'm optimistic that it's not going to be as bad as, you know, what we had in 22 and not as bad as like the 2007, 2008, 2009 market. That was a really bad market. All right. So any other topics or. So we talked about bonds. The bond rates have now uninverted, which is good. We're back to normal. But every time this happens, there's a recession. Every single time, by the way, without exception. So that's why it's like, oh, okay, the data may be difficult to interpret, but it usually does not lie. It tells you what's going on, and we'll see what happens. How are you like mentally? You know, you good? Or is it like, you know what? I'm going to get through this, and yeah, it's not fun to see losses on my portfolio, or is it like, and I hate seeing this, I'm just going to put it away and not look at it for 6 months?
I think it's like, you can kind of think of it like, once you've learned how to take a punch, you've learned how to take it. I learned how to take it a month ago, let's say.
Good.
That numbed me up personally pretty good. Now, it doesn't mean I'm going to completely check out. If I was going to do that, then I would just put it all in the S&P, right? If I was going to do that, I would do some bond. I would, the 90-10 Buffett portfolio, which is 90% S&P, 10% short-term bonds. If I was going to check out, I would do that. But I'm not going to completely check out. I'm going to keep an eye on it, and if it keeps dropping, then maybe I will start moving more into bonds.
Got it.
Otherwise, I'm just going to let it ride personally.
Good. Very good.
I don't know. What about you? Do you move to more defensive industries?
No. Here's my opinion on that is when we look at, sectors so there's 11 sectors, and consumer staples is a defensive stock, a defensive sector, right? So these are companies that we need no matter what. You're going to buy food, you're going to buy the necessities for home and so forth. But when you look at the long-term return, and let me see if I can add the long-term return here. So when you look at the long-term return of consumer staples, it underperforms most every other sector. It's down here. Energy is down here. Real estate's down here, and utilities are the worst. The best being technology, but that may give up some of its gains. So temporarily, it's going to be potentially a hard it's going to be hard for some industries within that sector. Consumer discretionary, healthcare. Healthcare can be a defensive stock, and meanwhile, it gives you a greater return than staples. So I don't move from, hey, over the next 5 years, I'm going to give up on this type of return, and so that way I can just protect my portfolio. I'd rather just move to cash, which I did, 3-4 months ago, leading up to some of these corrections. I sold some of my stocks, some of completely out of Ford, completely out of a couple of different names, and it created more cash, which is good. I'd rather do that than move to a stock where it's like temporarily I'm going to earn 5%, maybe 7%. At that rate, I'd rather just park it in a good short-term bond, make 4 or 5%. It's defined, it's set it and forget it, and I'm good to go. And then wait for the market to, give me good prices on stocks, buy those stocks, and then it's going to rise at some point. So that's how I view it, and that's what I'm going to do.
Yeah, makes sense. I mean, you could even look into municipal bonds, depending on your situation. Yield Nerd has videos on that, and I had a bond fund actually, and I'm considering buying into it again. I think I told you it's. I just mentioned it's NQY because it's look at your personal situation, right? But generally speaking, I think it is. It can reduce your taxes, and the yield is like between 5 and 6%. So again, but this is actually something that I wanted to mention. My personal philosophy: if you are going to invest in higher yield bonds, that is one thing where I would maybe suggest thinking of an ETF of some kind of fund, just because the risk is higher of default. Right?
Yeah.
So, just a thought.
Yeah, I think, we all get to pick the lane of investing we're going to do, the type of investing, and then, how far we want to go with investments. And I go back to, if I have to put that much effort to go from 4% yield to 5% yield, I'd rather not. I make a lot more money long-term on real estate and stocks. That's where I should be putting my time and energy. That's where I make, the difference between a 10% rate of return and 20% rate of return is doing your homework, finding the right companies, picking the right stocks. And 10%, yield differential is far better than going from 4 to 5. So that's my preference. That's what I think to do.
Can I ask you one other thing? This is leading to a lot of interesting questions, I think. We talked about annuities a little bit. And this is related, right? Now, I didn't know what an annuity was until I had to deal with my dad's estate, and he had one. And I realized what it is in the US, I just wasn't thinking about it. And then here, where I'm getting a little bit older and do think about it, it's just not a thing. Like, even though there's plenty of insurance here, Swiss people love their insurance, annuity is not a thing. But you know why? It's because typically people here have pension funds. And if you have a pension, you don't really need an annuity, I think, right? Maybe you could correct me on that. But it seems that if you live in a society where people tend to have pension funds, you don't need an annuity. But anyway, the reason I bring that up is my personal situation. I actually can buy in because I came here in my 30s. They will allow me to buy in more into my work pension fund. And that's basically a guaranteed fund. And it's in the Swiss franc, which is a pretty strong currency. I mean, literally, what is it now? It's like 18% above the dollar, I think. So that may not stay that way, but it never really goes much below. So anyway, I threw out a couple things for you, but I guess if I did a question coming out of that, it was, if you see where I'm coming from, that pension is kind of a similar idea to an annuity. Is that correct?
Yeah. Annuities, I think to the average person, annuities can bring value because, the fact that a person's saving their money for a rainy day or for their retirement or for their future, that's a very positive action. So I think it's great that people do that, whether they're putting it in a CD, and an annuity, a bond, or a stock. If you're saving, if you're putting away a part of your income, you're way ahead of the pack. Now, for me, like my mom is 88 years old, and she goes to the bank, and they're always trying to pitch her on it. Well, not always, but they've pitched her on an annuity. And then I read through the details, right? And there's just a lot of fees involved, and it's a black box. It's like, and it's also locks in the money. And so my mom on the surface, she's like, well, they're guaranteed this rate of return, and it seems like a good idea. And then we dissect it, and I explain it to her, and we always end up with her funds are in CDs and very low risk investments. And because she doesn't give up her flexibility and liquidity. If you go into an annuity, you kind of do. And you can't, if something comes up, you can't go to your annuity and say, hey, I'm going to need $25,000. Maybe there is an annuity of that type, but life happens. The air conditioner in my home, it's very hot in Southern California. We're above 100 degrees Fahrenheit. And on Wednesday, the air conditioner, it's a 20-year-old unit. It just blew up. It was not salvageable. So on Thursday, it was completely replaced. It was an $8,000 issue. Things happen in life, right? So if you're in an annuity and you need $8,000, where are you going to get it, right? If you have it in your savings account, wonderful. But if you had it in a bond, you can redeem or sell the bond. If you sell it through your brokerage. So anyway, so things like that. For some people, I think annuities are probably a good recipe because they just want defined benefits, and they don't want to touch a mathematical equation to figure out what's better. It's just not for me because it's too much of a black box, but for some other people, it's probably a beneficial.
Yeah, it sounds like a pension might be better than annuity because you actually, at least here, you can take a loan, or you can actually really withdraw in certain situations. Like I think if you're going to buy a home, you can actually withdraw some money from your pension towards the down payment here.
It's interesting here in the U.S., right? We have Social Security benefits. So when we reach a certain age, and if you paid into the system, you get to draw out. What really is a pension, right? It's Social Security payments based on how much you contributed. There's a maximum. If you're a high income person, you get maxed out. You put more into the system than, I guess, from a ratio perspective, than you're going to get back. That's just the way it is. And so that's a part of my plan. I have this spreadsheet that, is many rows and many columns, and I project out, how much money I will have and how much money I can leave to my kids. And I put the Social Security benefit in there, and I put it in at the age when I expect I'm going to start drawing those benefits, when my wife's going to do that, and put it into our overall cash flow for the next 40-year spreadsheet.
Yeah, now this is getting into another very interesting topic, which is very deep: retirement planning, right? And actually, I'm going to send you a website. Just check it out. Have you heard of FICALC? FICALC?
No.
It's something I got from another channel. I remember there's this like more passive investing, retirement focused channel. So check it out. It's like a calculator that helps you check failure rates. So depending on the amount of money you have and it's kind of like a stress test.
Yeah.
For retirement. And it's about, the 4% rule and stuff like that.
Right.
Anyway,
right.
I just put it in the chat.
Yeah. Thank you. And let's talk about retirement and kind of the things that, and I can't share my model because it just has too much private information in it. See, I'm looking at the website that you sent. So I looked at two retirement softwares models, and my complaint about them is that they're not tailored to the individual. They use kind of some general, buckets, and that's good for the average person. Now, I personalize my model, like very precisely around my wife and I, and that's what you miss if you use a software versus you create your own. Creating your own is more difficult. You got to have the knowledge and know what to do. But the way that I've created it, I know every number, and I could clearly see how much money we're going to have. The percentages of growth, I mean, those are all formulas. Those are all calculations. You can put them into a spreadsheet. The models that, come in a software package, they're very useful. They're good to put your information in there and have a very good understanding of where you're at. And it'll probably get you there within 80 to 90% accuracy. For me, I just thought, I'll build my own, because I looked at two very closely. And I actually used to have I had extensive conversations with a YouTuber out there who's very good, and he does retirement planning. And we went over his model. I showed him mine, and he said, yeah, you're good to go. And what I understood is, their intent is to manage your money, and they want to charge you, in that case, it was 1% of managing your money. That's a big expense.
1% is a lot.
Yeah.
Even think about that, right? Like, I have an ETF, which is 0.25%. And I know that's not that bad, but even that's, I'm kind of like, for me, that's kind of the limit.
Yeah. So I think a good retirement planner, there's been some coaches that I've had, like for fitness. There was one coach who's excellent, right? And it was really affordable, and he was really good. And I've had other, kind of areas of improvement where I've had coaches, and they were excellent. Very, how should I say this? They provided enough, but it wasn't like, hey, I want to talk to you every day, and FYI, I'm going to charge you this amount every week and every month. Now, there should be like a financial planning category of, a financial coach. And it's really just to bounce ideas and approaches. And then that person identifies blind spots or identifies potential areas that you should look into further, and maybe agrees with a few things you have, right? But they don't like find a problem, then try to solve the problem for you. They're more like, hey, I get what you're trying to do, but you may want to consider, just as an example, more fixed income. And these are the reasons for it. And at your age, you really got to start getting good at that, because it's just going to become more and more important over time. I could see that being a pretty good little blind spot for somebody. And then they're off to do their learning around fixed income, and they become a better fixed income investor. So I think I don't know if the market has that. I mean, the actual financial advisor doesn't make as much money, so maybe they don't like it. They're like, no, don't offer that, because we just cut our fees, by 80%. But I think we're in an age where there's so much good information. There's so much to work with. If you hire a money manager, a financial planner, I believe they get in my way. They prevent me from really getting high returns. They prevent me from really getting into great investments, because it's just one more, it's so much like bureaucracy. It's one more person that has to be involved in a decision. And they're accustomed to dealing with people that are like, oh yeah, what 5 ETF should I be in? Okay, perfect. All right, great. That was a 10-minute meeting. We're done. All right, see you later. That's not me. I'm very active, very informed, and there's very little value add that a financial planner can provide. But I would really like a coach, and I've actually sought out other investing, kind of YouTubers, and said, hey, I would really like you to look at my portfolio and say, hey, I get it. I would say that this piece doesn't make sense to me, and I think this piece has too much risk, or this. And then I may not do anything with the information. I may research it and say, well, that's what I want to do. Or I might say, they have a good point. That's a blind spot that I should get stronger in.
Yeah, you need someone to just review the plan that you already have. Right?
Yeah, and do a checkpoint once every 6 months kind of approach, and just talk about what's new and what's the topic. What do you want to accomplish over the next 6 months? Oh, okay, well, we're in a down market, this, that, and the other. So I think there is room now for that type of coaching, because again, investing is so fun and exciting now, where we have information at our fingertips. At some point, I would think that the stock market is going to become a 24/7 exchange, like crypto. I don't understand why we have to follow business hours. Everything runs on computers. It's nice that they give the computers time off so they can go on vacation and spend time with their family. I don't get why they don't have 24.
They do
What's
need
that?
maintenance, to be fair, as you know, right?
Yeah, but I know technology well enough that there's a lot of industries that are 24/7 operations, and you can do maintenance by having distributed workloads. You just put it simply as you have 5 servers handling a workload. You take one server down, you update it, and then you put it back into service, and then one at a time. You never take all 5 down at the same time.
I'm right there with you. Cloud computing, all that. Exactly. That's exactly the point.
I just scratch my head and I go, we have Wall Street hours that we had 100 years ago. It's like, why? If anything, give us 12-hour trading. Why is it on the West Coast trading stops at 1? It's always been I don't get it. Why is it, and then you have what I think is greater volatility, because like on an open, stocks will run up. Why? Because we haven't been trading from 4 p.m. Eastern until 6:30 Eastern. So what is that? 14 and a half hours. So there's all that pent up trading volume for 14 and a half hours. Well, that creates more volatility. And if you like volatility, keep doing what you're doing. But if you had a 24/7 market, as soon as the news hits, let's say in the middle of the night, Chevron, which is one of my stocks, has a big oil spill, then that stock's going to be hit right in the middle of the night. And traders could get on that move, sell their stock or buy their stock, whatever they need, 24/7. I think that's in the future because it makes too much sense. I mean, we're already in the cusp of artificial intelligence. Why are we still dealing with a stock exchange that's on the old paradigm of business hours, when people used to go into work, and people still do, but they have a trading floor where they used to deal with paper and these very old school trading boards where they would, put up physical numbers to represent the stock. So it's just an exchange. I think they could really modernize, if anything, just the paradigm of, hey, we can do 24/7 now. The computers can handle it.
Yeah, to your point, I think NYSE is actually doing a study now to see what would be needed and to see the ramifications for 24/7 trading, or at least certainly to extend the hours.
I think, thinking of that retail investor, right? If you live in California in the US and you work all day, let's say you're a nurse and your shift is from 6 a.m. to 6 p.m. Tuesday through Thursday. And so for those 3 days, you really can't trade. You'd have to do all put in your orders in advance, and it gets harder for the investor. Now you have to say, okay, I'll specify a price and this, that, and the other. And, 24/7, that nurse can get home at 7 p.m., have dinner, get their bearings straight and look at the market. Okay, it's 8:30, watching Netflix. I wanted to buy some more Amazon. I'm going to go ahead and put an order right now, and it's going to process and transact right now at 8:30 p.m. versus, the market closed 7.5 hours ago. I'm going to have to put in my buy order. It's not going to be executed till the next day, next trading day. If it's a Friday, it's even worse. All that stuff is like, why are we still dealing with that? We should go to a 24/7 market.
Yeah.
Anyway, so
I just wanted to mention something, because you were talking about the idea of a financial advisor. There are advisors and planners who will just coach you and review the plan that you have. Actually, the other channel I watched, he had a list somewhere, because this question has come up on his live streams, but I can't find it at the moment. But yeah, there are people that will do that for you. They will give you advice. Also, there are people that go on a flat fee. It doesn't always have to be a percentage. And now, if it's a huge flat fee, okay, but there are people that will just do 100 or 200 a year, something like that. So if I find a list, I'll send it to you, because
thank you.
Useful.
Great. And if any financial planners listen to this video and you provide that service, send me a message. We'll highlight you. Maybe we'll bring you on one of the podcasts and you can answer questions for everybody.
Fun fact, CFP is actually a global certification. Now, some of my family is a CFP in the US, but I looked into it here. There's actually training here in Europe to be CFP, same certification, just in your local language. So
very good. All right, so let's kind of land the plane on this call. I wanted to have the call just because it was such a down week, but you know, it comes with the territory. Equities, this is part of it. I thought it was a good opportunity week. We'll see what happens next week. But I really appreciate both of you tuning in and doing the podcast with me. I wish you a very pleasant Sunday and a very nice week coming up. Thank you.
Same to you.